Welcome back to another edition of Market Takes. I know you could have been anywhere in the world, but you're here with me and I appreciate that. Thank you so much for being with us on Market Takes. Listen, today we are diving into the state of housing. We're talking about the interplay with inflation, and we are looking at the U.S. housing market through the release of today's U.S. existing home sales report. Big release because the overwhelming majority of all homes sold are existing homes. So we are breaking that down. I know if you've been looking and reading the headlines, it seems like it's all bad news, but the real news, there's some good and some bad. We are going to get into all that because that's what we do here on Market Takes. So listen, we are going to talk through what today's existing home sales report showed. We're going to talk about the overall state of housing, the big picture. We're going to check in on the markets because we're going to see what investors are thinking about, how they're reading today's report. And then we're going to talk about the overall role of housing in inflation, the big picture, because that's what it's all about, right? It's all about what's happening with inflation because the Fed is watching inflation, and the Fed is basically what's moving everything. So we're going to talk about that. Of course, I'm going to tell you what to look out for next because even though it's backward looking data, we are always looking forward. And that's really what we're going to do today here on Market Take. So thanks again for being with us. Listen, today's report showed home sales fell to 4.4 million in March. Now, I want to throw a chart up here on your screen and just give you a look at the overall trend. Now, this goes back about a year, and as you can see, starting April 2022, you're just seeing consistent declining until January even goes a little bit below, and then that February number, boom, that's a 15.4% increase from January to February, and then a small decrease from February to March. Now, what we have seen is there was a 2.4% decrease from February to March, and that was lower than expectations, actually. Expectations were about 4.5 million homes sold. It was 4.44. And sales also declined 22% from a year before. If we'd gone all the way back to that March 2022 report, you would have seen that. So you see the overall trend lower. But do not be fooled. What we have seen is consistently still high reports. As you see up there on your screen, the March reading is the highest, if not for that big jump in February, this would be the highest reading that we had seen since October of last year. And also overall prices ticked up to 375,700. That was higher than February's increase, which was the first decrease that we had seen in 131 months. So this chart is illustrating the overall trend, which had been lower and now is picking back up. And even though it decreased this month, we are still holding at those much higher levels in terms of the number of homes sold. So the other big piece to watch this, February was a big month. That may have marked a turning point in the housing market where people stopped being so bearish and saying, you know what, buying a house isn't for me, and said, hey, you know what, maybe it is. You saw that end a streak of 131 consecutive months, almost 11 straight years of prices going up every single month, year over year. That is the longest, or it was the longest streak on record. But now we've seen an increase of housing prices again, suggests that that decrease we saw last month may have been an aberration, an unusual phenomenon in the data. We are seeing prices pick back up again. So you saw that decline small, but still prices went back up and holding at higher levels. Those are the big pieces that you need to take from this report. If you were going to take away anything from this report, we're going to get a little more down into the data, a lot more down into the data. But if you walk away with one big picture takeaway from this report, it is that we are seeing a small decline from February, but still holding at much higher levels than where we had been. And the trend has been thrown off, and we are no longer seeing declining, consistent declining year over year, month over month sales of existing home sales. Another big trend that you want to watch out for, I want to throw a chart up here on your screen to just give you an idea of what we're looking at in the markets. This is the U.S. Home Builders Index, the Dow Jones U.S. Home Builder Index. Basically, this index watches all the big U.S. home builders. We're talking KB Home. We're talking, what are some of the other ones? D.R. Horton, Toll Brothers, some of those big names. Those are all what makes up this index. The big home building companies. There, you are just seeing a big, huge takeoff and increase in prices. That's been one of the strongest sectors over the past over the past 1 year time frame. This index is up almost 36%, and today it's up over 4%, 4.3% increase today. So long term, this has been a big increase, and you're seeing the stock of home builders rise. That tells you that investors see home builders and homes more construction, more building, more sales, all those things for home builders. That's a good thing if you own those stocks. It may not be such a good thing if you're looking to buy a home. So that chart illustrating what we have seen overall from the home builder index and what investors, stock pickers, stock buyers think about the US housing market. They think that things are about to go up in a big way, which means higher prices likely on homes, more competition. The one good thing you could take away from that though, if you're looking at buying a home, if you're someone who's in the housing market hoping for a decline in inflation, that also when those home builder stocks rise, that means they build more homes, which means we get more supply. One thing that we have had is a consistently low level of supply, as in not a lot of houses on the market for sale. Well, if those home builders get bullish, and as we saw last week, beginning of this week, if you watch Market Takes, the US home builder index showed confidence starting to pick back up, prices starting to pick back up, could mean more supply is coming into the market. This could be potential good news for home buyers. We saw the total housing inventory in March, 980,000 units, just a little bit under 1 million units. That's up 1% from February and 5.4% from a year ago. Unsold inventory is at about a 2.6 month pace. That is still very low historically, but that is up from 2 months inventory that we had in March 2022. So housing supply is slowly but surely increasing. Here's the bad news though. On the other side of that, you are seeing more folks stepping in and buying that. So even as we are getting a little bit more supply, we're seeing a lot more demand. And every time those interest rates go down just a little bit, those mortgage rates go down just a little bit, we're gonna talk about that in a second, you're seeing people jump in and seeing a lot of folks buying and looking to buy and making that a real crowded marketplace once again. So speaking of marketplaces, want to throw up one more thing here on your screen, and that is we're going to take a look at the live markets, what's happening in markets right now. So want to just highlight a couple things here. You see overall stocks are down, but you see this difference here between what we got on the Dow and what we've got on the NASDAQ. So when we're looking at the Dow, right, the Dow Jones Industrial Average, you see it hits its low point of the day right around 10 a.m. when this existing home sales report comes out, and then you see prices just really picking back up. You've seen some of that come off, but we didn't see that in the NASDAQ and we didn't see it as much in the S&P. Now, why is that? Well, the Dow Jones Industrial Average, or the NYSE, has about 21 home building companies. The Dow has more of those home builders than the NASDAQ. NASDAQ only has 9 total home building companies, and a lot of them are pretty small on it, whereas the Dow has a lot more of those home builders in it, and that's why you're seeing that divergence between the Dow and the NASDAQ. Now, when we also look out here at bonds, right, let's take a look at bonds. We're seeing yields coming down. We're seeing overall, that means prices are going back up. People are buying bonds, and really what that means is risk off. We are seeing a decline in risk appetite. You see it here with crypto, just negative, all in the red across the board. The more you get out on the risk scale on some of these coins, the more you see that big decrease in crypto prices. Another thing you're going to want to watch for is commodities. As you look out right here on commodities, you're seeing crude oil down across the board. We're also seeing lower prices in copper, Dr. Copper as it's known. Since about that 10 p.m. point, you're seeing a decline. That's less about this report and more about the leading economic indicators report that we also got at 10 a.m. That showed another decline, the 12th month in a row with a negative reading. If you go back the last 15 months on the leading economic indicators, only February 2022 is more than zero. Folks, these are recession levels. Historically, if you look back when we've had a recession, we are at recession levels on the leading economic indicators, and I think that's why you're seeing some of this risk off in crude. You're seeing it in copper prices, which is a measure of the economy, and you're seeing gold right here pick back up as you see folks buy gold when things are worried. So that just illustrating how investors are seeing the data that we've gotten out on the market so far and what we're talking about when it comes to the outlook going forward in the market. We can't go on today without talking about how this influences and impacts things for the Federal Reserve, the Fed. Listen, when we look out at Fed funds futures, basically what investors are betting the Fed will do, they are believing that the Fed is locked in for May, that next month when the Fed meets, and they're going to announce it on May 3rd, the investors say the Fed is locked in for a 25 basis point increase of rates. 87% of investors see that as the likely outcome. But when you look out further, you are seeing expectations for more cuts. A lot of folks had bet that the Fed was going to start cutting rates as soon as July. Those expectations have been kind of pushed back a little bit into August. But what folks are saying very clearly is they expect the Federal Reserve to raise rates next month and then start cutting them back. And that's having a direct impact on housing, because if the Fed cuts rates, that means mortgage rates start to get lower. Investors in the 10-year treasuries have already gotten out ahead of that and started reducing and buying more 10-year treasuries, which is bringing down the yield, which raises the prices, and that's what we're seeing. Want to put one more thing up here on your screen, and that is the 30-year fixed mortgage rate. As you can see, that just spiked up as we got through 2022. Into 2023, it's kind of come down a little bit, but very clearly on your screen there, you see well above 6% still, more than double where we were in early 2021 and even at the beginning of 2022. So mortgage rates are still very high historically. We're higher than we've been anywhere in the last 10 years, as you see there on your screen. But anytime mortgage rates come down, you're seeing buyers very, very sensitive to price. And you see that little decline there at the edge of your screen. That's what's prompting a lot of this buying and some of this boom you're seeing in home builder stock. So that just illustrating again how the market has responded, the overall mortgage market, and how investors have responded. And that's pushed the mortgage rate down. That's allowed some more folks to buy in, but really not a big change, as you can see, in the overall environment for mortgages, for housing prices, but it's having that psychological impact. People see mortgage rates go down just a little bit and they rush out to buy, and you're seeing pickups in the overall rate of housing purchases. That could throw the Fed off of what they want to do. The Fed wants people to not take out mortgages, not go out and buy homes, not refinance their house to go out and buy some more things, maybe refinish the deck, maybe make some home improvements. They don't want you to do that. They want you to stay home, say, wow, these prices are too high. I need to fall back and just let things settle down. People aren't doing that. That could have big implications on the rate of inflation. Listen, housing, aka shelter, is what they call it in the CPI, the Consumer Price Index. Housing is about 1/3 of that. It's exactly 32.77% of the overall CPI metric, but about 1/3 of CPI, and core CPI, which is what the Fed looks at even more closely. The shelter index last month accounted for over 60% of the total increase in core CPI. So we saw even as overall CPI inflation declined, we saw that core number pick up, excluding food and energy, and 60% of that, more than 60% of that, was due to housing. So we are seeing housing prices start to pick back up again, moving in the opposite direction of what the Fed wants. That could have implications for inflation. Obviously, this is people's biggest outlay, the biggest thing they spend money on each month. That could have big implications for the Fed and for the market. So that's why you want to watch housing prices. That's why you want to watch what's happening here, and mortgage rates and all that good stuff. Another thing to watch out for, energy prices. We saw energy down a little bit today, but we're back at that 80 level. We have seen oil prices really pick back up and rise over the past few months. That'll be something to watch out for. Energy not as important in the CPI and overall inflation, but it has a big role on market psychology. When people see the prices at the pump rising, they think, oh man, prices are going back up. My sentiment is lower. I don't want to go out and buy as much because I'm having to spend so much here on gas. That's a very big psychological impact. And it also tells people inflation's probably going back up. I need to ask the boss for a bigger raise. I need to look for a new job that pays more because I can't deal with this high inflation. Watch out for oil prices there. So listen, the bad news, this report suggests that inflation could be picking back up. Housing prices, which are a big piece, could increase inflation and cause the Fed to have to do more, to tighten more, to raise rates. The good news, this could mean the increased bullish sentiment for home builders, could mean more building, more supply, and that could bring prices down for home buyers and prospective homeowners. Listen, what to look out for next. All right, we have a big report coming on the Fed's discount window borrowing later today at 4:30. We get that number. That's definitely something you're going to want to watch out for, because the Fed, again, while they're raising rates, they are also pumping a ton of money into the financial system. They have pumped almost $400 or over $300 billion into the banking system. That means that it loosens financial conditions and makes it harder for them to affect policy with their interest rates. Loosening financial conditions could mean tougher financial conditions for small businesses, for banks, for consumers even as they're making things looser for big banks, for big corporations, all those folks. So you're going to want to watch that number out today at 4:30. The Fed's balance sheet is approaching $9 trillion. That would be a record high. That would be big. We've got new home sales coming on Tuesday and next week, and manufacturing and services PMI, those purchasing managers index, those are on Friday. Earnings reports this week we've got Procter & Gamble and L'Oreal coming out on Friday. That's tomorrow. Watch out for that. Next week we get Microsoft, Alphabet, Amazon, Meta. You also get Exxon and Chevron, the big oil giants from the US, Johnson & Johnson, Visa, MasterCard, many more. We will break all that down for you on Monday here on Market Takes. I hope you'll be with us. Hey, listen, that's going to do it for this edition. Like I said, you could have been anywhere in the world, but you're here with me, and I appreciate that. Thanks for joining us here on Market Takes. We'll see you next time.